Welcome to today's Explainer. We're looking at a massive economic domino effect that is currently reshaping the entire global landscape. It's honestly wild to see just how interconnected the global economy is right now, so let's trace exactly how one single event triggers the next.
Okay, let's dive right into this. Is the war finally spooking Wall Street? That's the central mystery we're unraveling today. We're going to trace exactly how a geopolitical conflict playing out on the complete opposite side of the globe is directly shifting the foundation of your stock portfolio right now.
Section 1. The domino effect begins. The geopolitical catalysts.
To really understand today's stock market, we have to start with the very first domino, and that's the prolonged shutdown of the Strait of Hormuz due to the ongoing war in Iran. That shutdown has created a severe geopolitical supply shock, pushing West Texas intermediate crude oil prices right past the $100 mark, settling at a staggering $102.18 a barrel. And look, this isn't just a number on a commodities trading terminal. It's the massive force that sets our entire economic chain of events into motion.
Section 2. Inflation's welcome gift, the macro shock. Let's move to the next step and see how this builds, because a shock in the energy market translates almost instantly into a macroeconomic shock for everyday consumers. In April, the consumer price index jumped to 3.8% year over year. That is literally the fastest pace of inflation we've seen in 3 years. And if you peek under the hood, over 40% of that increase comes straight from higher energy costs. I mean, gasoline alone is up a punishing 28% from last year. So the geopolitical shock has officially hit the gas pump. And that leads us to a massive dilemma over in Washington.
Actually, it creates an unwanted welcome gift for incoming Federal Reserve Chair Kevin Warsh. He officially replaces Jerome Powell this Friday, and he's taking the helm at a really tricky time. Warsh comes in having advocated for lowering interest rates, but instead he inherits this massive inflation headache fueled by a global supply shock that the Fed's traditional monetary tools just aren't really built to fix.
So, what does this all mean for the big picture? Well, it completely shifts the timeline of expectations. Back in March, the market was fully expecting rate cuts. Now, following this inflation spike, experts like Seema Shah from Principal Asset Management are warning that the next rate cut might be pushed all the way back to December or, believe it or not, even out into 2027 if the conflict drags on. The conversation has completely pivoted from when do we cut to do we actually need to raise rates again?
Section 3. High stakes in Beijing, the diplomatic pivot. With the macroeconomy under such immense pressure, world leaders and top corporate executives are stepping in to try and navigate this exact pressure cooker. At their upcoming summit, both President Trump and President Xi arrive with very distinct, tangible goals. President Trump, who, by the way, is traveling with a delegation of executives including Elon Musk and NVIDIA's Jensen Huang, is looking for China's help in ending the Iran war alongside securing massive purchases of U.S. products. On the flip side, President Xi is facing an economic slump at home, so he wants a more predictable relationship with Washington and seeks leverage regarding U.S. commitments to Taiwan.
But as you can imagine, there are some severe tripwires complicating these negotiations. For instance, China is actually Iran's largest oil buyer, and the U.S. has already sanctioned Chinese refineries over this exact issue. Furthermore, a federal appeals court just granted a temporary legal reprieve that keeps President Trump's 10% global Section 122 tariffs in place for now. Add in some thorny issues around advanced AI tech access and drone supplies, and you've got yourself an incredibly delicate diplomatic chess match.
Section 4. The corporate profit pinch, the squeeze on goods.
Now, zooming in from the macropolitical level right down to the corporate level, this dynamic directly triggers what we call massive margin pressure. Just to be clear, margin pressure is the intense squeeze on corporate profits that happens when raw material costs rise much faster than a company can actually hike its consumer prices to compensate. There's a lag time, and during that lag, profits absolutely get pinched.
And this brilliantly illustrates the concept in the real world. With oil sitting over $100, polyethylene, which is the most common plastic in the world, has hit a near 4-year high. For a consumer goods giant like Procter & Gamble or Mattel, that translates to an estimated $1 billion annual headwind. That's huge. But look at producers like Dow and LyondellBasell. This price hike is a massive tailwind for them, effectively returning them to high profitability. So one company's pain is quite literally another company's profit.
Section 5. Tech takes a breather, the market reality.
Now we finally arrive at the last domino, the trading floor.
Amidst all this economic uncertainty, the seemingly unstoppable artificial intelligence hype is finally taking a bit of a breather. We saw a sharp pullback in high-flying semiconductor stocks after a historic 173% run over the last year. Intel dropped 6.8%, Qualcomm fell 11.5%, and the broader PHLX Semiconductor Index, the SOX, slipped 3%.
Now, what's really interesting about this slide is the glass-half-full reality hiding underneath that tech sell-off. The broader S&P 500 actually saw more individual stocks advance than decline, 259 gainers versus 243 losers. This improved market breadth tells us something absolutely crucial. Investors aren't just running for the exits in a panic, they're deliberately rotating their money.
And they're rotating it into what experts are calling hidden gems. Rather than just relying on the Magnificent Seven tech giants, agile funds like the Chase Growth Fund are capitalizing on this exact rotation by buying into infrastructure, healthcare, and industrials. Just look at Mastech, a company pivoting heavily into oil, gas, and power grid construction. Or BrightSpring Health, capitalizing on the rising demand for home-based care for an aging demographic. And Littelfuse, making the critical industrial electronics needed to modernize the power grid. When the big tech giants stumble, these are the under-the-radar beneficiaries catching the capital.
However, to be totally fair, we have to acknowledge the deeply bearish sentiment that absolutely still exists in some corners of the market. Michael Burry, the famous big short investor, recently issued a pretty stark warning about current tech valuations. He actually compared the recent frenetic trading action to the scene of the bloody car crash minutes before it happens. His argument is that on a forward earnings basis, the market is way more expensive than it appears on the surface. But hey, if Burry's quote makes you think all risk appetite is completely dead, let me show you something wildly unexpected. Down in Lower Manhattan, at Church Street Boxing Gym, traders are literally battling it out in esports-style live crypto trading competitions. While a DJ plays in the background, they're furiously trading Bitcoin, Ether, and meme coins on their laptops for a $10,000 cash prize and, get this, an ornate Japanese katana. No way, right? It's basically an underground rave of high-octane trading, proving that while tech stocks might be taking a breather, the raw, visceral appetite for financial risk is still very, very much alive.
And that brings us to our final thought. Geopolitics in the Middle East, surging inflation at home, diplomatic summits in Beijing, corporate margin pressure, and a stock market rotating away from big tech. These are all deeply interconnected dominoes. As we watch this rotation unfold, and as world leaders negotiate the economic future, you really have to look at your own portfolio and ask yourself, are your investments prepared for the dominoes yet to fall? Thank you so much for joining me for this explainer. Keep learning, and I'll catch you next time.